Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I'm Ryan Nauman, the market strategist here at Zephyr. I have a fantastic show lined up today and one that's going to be a lot of fun. Equities have been on a fantastic 15-year run. In fact, the past 15 years have been one of the best 15-year runs in history, only behind the post-World War II expansion and the tech boom of the 90s. However, some believe we are at an inflection point due to lofty valuations. Well, I have on the perfect guest to talk about this and potential strategies moving forward. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. All right, enough from me. Let's go ahead and get started and move on to the star of the show. My guest, he doesn't need much of an introduction, but here it is. It is such an honor to have Meb Faber on the show. Meb is a co-founder and CIO at Cambria Investment Management. He is also host of the very popular Meb Faber show. Meb, thank you so much for coming on. I have been looking forward to this show for some time. Can you please tell us just a little bit more about yourself and Cambria Investment Management?
Sure. Well, we can rewind to when I lived in Lake Tahoe. I like to think I was working at the time, but really it was kind of glorified ski bum. And lived up in Tahoe City, up in Dollar Point, worked in Incline Village, and was there for a couple of years. Really peak. We had some amazing seasons. This is early 2000s. Everyone in San Francisco was sad and depressed from the dot-com bubble bursting and bear market that ensued. So decamped to Tahoe, got some skiing in, and then had this crazy idea. Well, the company I was working for folded, and so thought about moving back to the Bay Area and said, you know what? I got a college buddy down in Los Angeles, Manhattan Beach, and had chatted with a fellow that said, hey, let's start up an investment advisory. So I said, worst case scenario, I'll go live at the beach for a year, assume I'm going to hate it. Los Angeles, full of vampires, soulless people. If you were from NorCal, that was kind of the mindset. I moved down and I kind of looked around. I was like, it's kind of nice. So traded my skis for a surfboard, and 1 year became two became 20, and here we are. Started this company, Cambria. Really didn't know what we wanted to be when we grew up. Started writing and publishing. Global financial crisis happened, so it was blogs and academic papers and books. And back then, we saw this ETF opportunity. We started sub-advising on a fund.
Okay.
And then back then it used to be hard. You had to get your own trust. You had to pay like $500,000. It took like a year, legal fees. Today, anybody can launch an ETF. It's easy. Yeah. Back then it was tough. And so we finally bit the bullet and did it. Started launching ETFs in 2013. And then now, fast forward, 12 years later, we have soon to be 20 funds and over $3 billion in assets and over 150,000 investors around the world. And it's been a lot of fun.
Meb, I love it. I love that story. I love to talk about Tahoe. It's a family show, though. Family show. My son watches every once in a while. So we, got to keep those Tahoe stories. Maybe we do a Adjusted for Risk After Dark episode, and we can talk some.
But it's funny. You talk to your son, you talk to your friends, and I'll tell them this. I love. We're getting old, so we pick on the youngins now. We're the old man shouting at the crowds in the moon, and the young folks. Young folks always think they have it hard. And I just want to go tell all my young listeners, when I lived in Tahoe, we must have had, I don't know, half a dozen people in like 2 or 3 bedroom house that we wedged in there. I had someone who lived in my closet. And I'm not joking, listeners, like legit bedroom in a closet to save money. And so this was well into my late 20s. So anyone who's worried about their station in life and when things are tough and buying a house and all that stuff, it gives a lot of fond memories as well.
Yeah, I completely agree. And I've got a lot of ski bum friends that they will live and sleep anywhere as long as they get that powder. And but there's worst place is to be living in a closet, right? So if you're gonna do it, Tahoe's a good place to sleep in a closet, I guess.
And this taught me an early lesson in diversification. So I had one friend who worked at Garwood's, so you
Yeah.
could get free drinks and fish tacos. I had one friend that worked at Tahoe Dave's, so you could get free gear and rentals. I had one friend that worked on the mountain and another that was in the ticket department. So not too many times, listeners, we would definitely be part of a large Japanese or Korean visiting ski group to maybe get a free ticket to North Star. Maybe wouldn't recommend that to my younger folk, but in your crazy 20s, that was a
Oh,
early lesson in diversification.
yeah, fantastic, fantastic. I would love to keep talking about that. But my next question, before we really get started, is where can I get one of those sweet hats? It's the best swag in the
Ask,
industry.
you email us, we'll send you one. We got a whole, you can't see them up here, but we have a new book coming out next year. And so when I'm bored and trying to avoid doing my day job, I'll go design some new hats. So we must
Nice.
have 20 different styles and variations now. So we're happy to send you one if you email us. Yeah.
I love it. I love the hat. So yes, I will. You'll definitely be getting an email from me with my address for a hat.
Perfect.
All right, Matt. We should probably. I'd love to talk Tahoe, but probably should get started. At the opening, I discussed the amazing run equities have been on the past 15 years, and according to some media outlets and headlines, the rally may be running out of gas. Plus, everyone knows valuations are lofty, which really doesn't bode well for future returns. Do you think that current valuations do they concern you?
I want this party to keep going, man. I was got to experience a little bit of the late 90s, was in college, but I had a lot of friends that moved out to San Francisco and used to go visit. And, every happy hour had free champagne and food. And there used to be a website that would just list all the .coms and each night where the free food and happy hours were. And it, definitely feels like the money is flowing again. There's nothing that says this party has to stop. I think there's a few takeaways I think that are important. One is to at least come to an understanding of how good it is right now. I went on TV the other day and I was like, let's be clear. Like, if you're a financial advisor, you sit down with your clients and review the year end and say, hey, this is as good as it gets. Like, this is amazing. We've had 15% returns for as far as the eye can see, but asterisks, you shouldn't expect this, right? You look back the last 100, 200 years in markets. Our new book goes back to the 1600s. And you say, look, over time, is this normal? And the answer is normal in the sense that it does happen. As you mentioned, it's happened, roughly three other times in the past 100 years. It's been a 10 bagger in US stocks, 20 bagger in the Qs. Exceptional period. And a lot of people come to expect that. I mean, 15 years is a career for most of us, right? And so the challenge is that you look back in history and say, well, has this been the case? Is this normal? And you say, well, equities traditionally have done like high single digits. And there's been three other periods where for 10 years rolling, they've done 15% a year, roaring 20s, nifty 50s, internet bubble. But on the backside of those, you had some names for some not so good times: the Great Depression, inflationary 70s, .com bust, and GFC. And so the long history of markets is, yes, there is, let's just make it simple, average return of 10% per year. But if we know anything about markets, that normal market returns are extreme. Up 20, flat, down 10, up 40, all over the place. It doesn't just go up 99999 every year. The downside of usually a roaring bull market is after this big run, the market is expensive. It's now second most expensive to the late 90s, but doesn't mean it has to crash, doesn't mean it have to go down. In fact, it could keep going up. We're at a 10-year PE ratio of around 40, and in 99, it peaked out at 40. So all this excitement about AI, which is super exciting. But on average, if you go to the blackjack tables down in South Lake Tahoe or on a county line up in North Lake, if you know anything about blackjack and odds, crazy things do happen if you're playing poker, etc. But on average, the expectancy from where we are on the valuations, let's call it low single digits. So not great. And I'll give
Mhm.
you Some good news. The good news is there's lots of other places around the world to invest that are
Yeah.
cheap and even within the US market. So it doesn't mean that dour times are ahead. It just means on average appreciate what you've had, but also be mindful that it is the good times may not continue forever.
Yeah, very good point. And like you said, I don't want to burst this bubble or put bad news out there because we've had such a great run. But let's say, you know what, the parties ended, and I'm not saying we have a correction bear market, but let's say just like 15% returns are over with. We get single digits. Is there anything that investors can start considering doing to maybe, all right, and we've had fantastic returns, the S&P 500, it's very top heavy, right? We've had, and everyone likes the cap market index. Is there a different strategy that investors can maybe think at if returns do slow?
Yeah, this is a perfect lead in. So the diagnosis, look, market cap weighted US stocks are expensive, they're concentrated. What's the prescription? And this is great news. So we wrote a paper a couple of years ago. One of my favorite papers we've ever written is called The Bear Market and Diversification. And it was saying if you're an investor, you're an advisor, and you diversified over the past 15 years, it's been a rough go relative to the S&P. You did totally fine. You probably still did 8, 9% a year, but S&P did 15. Your idiot neighbor who put all of his money in SPY or Qs or Mag 7 has crushed you and has told you about it every quarter for the past 10 years. If you're an advisor and you sit down with clients, every time you sit down, they say, why do we own bonds? Why do we own REITs? Why do we own foreign stocks? Why do we own commodities? All this, right? So you mentioned this. This has arguably been the worst period for a diversified portfolio, and it doesn't even matter which one. Risk parity, endowment style, on, 60/40, anything diversified versus the S&P since really post World War II in terms of years in a row of underperformance and magnitude of underperformance. However, it feels like that's starting to change. You're seeing, so everyone still talks about US stocks, still talks about Nvidia all day on CNBC, but if you look underneath the surface, there's a lot of other things that are percolating up. Gold's having a great year. Foreign stocks are having a great year. Emerging markets, value outside the U.S. is having a great year, on and on. So a diversified portfolio. Let's start with the base case. Most U.S. investors, their base case is all in on U.S. assets. So their stock exposure is probably 80 to 100% U.S. stocks, even though U.S. stocks are only 2/3 of the world market cap and only 25% of global GDP. And then if they own bonds, it's, let's be clear, it's only U.S. bonds. They almost never own foreign bonds, despite the fact that foreign bonds are arguably the world's largest asset class. So the first step that investors can do is break that home country bias, so they can move globally into foreign and emerging, at least get to the Vanguard market cap index. And then second is you break the market cap link within the U.S. So instead of just SPY, you could do things like value. You could tilt towards small and mid caps, which have been horrific for 15 years. We obviously like shareholder yield. You could, and then another big thing that's missing for most portfolios we see for Americans, less so for other countries, is the real asset exposure. So things like gold, commodities, commodity equities, REITs, tips, all those type of assets tend to do particularly well in certain environments that hedge a little bit of US. And then the last one, which if you're totally crazy, is you could be adding a little trend following. So all these ideas mixed into one, I think, are great diversifiers relative to a traditional just all in on U.S. Stocks and bonds.
Yeah, Matt, that's fantastic. I recently did an article on, I think diversification is back. And a lot of it now, we're getting back to normal a little bit. Interest rates are back normalizing, inflation's normalizing. I think that bodes well for, diversification. Right. And for the past 15 years and most recently, S&P 500 has been top heavy. I think, depending on the day, it's like 30% of the index, over 30% of the index is in the top 10 holdings. What impact does that concentration risk have on investors? Like you said, it's worked really well, right? People like diversification. Why? When I can get, invest in NVIDIA. With the
And
surge in
there's some,
popularity of cap weighted investments, what's the risk there?
cap weighted. It's an odd bird if you think about it. Look, you go back 50 years, John Bogle and others, amazing invention. But it's actually not the cap weighted part that was the amazing invention. It was the fact that what it allowed for, which was low cost investing. So because market cap weight, you literally don't do anything. You could buy 500 stocks, let them float. It's like very low effort. That allowed you to run that fund with very low headcount and staff and expenses. So therefore you could do it at a lower cost. Well, the modern age, you can run any strategy, at that sort of low cost level. And so then if that's the case, a market cap weighting, the only determinant of market cap weighting is size of the company. What a crazy way to invest. You invest more as it gets bigger, less as it gets smaller, which is essentially just the stock price going up. And so there's no tether to earnings, valuation. Now, the biggest benefit of market cap weighting is you're guaranteed to own the winners. So power laws of investing, that means you're guaranteed to own McDonald's and Walmart and Nvidia and Apple. But you're also adding more and more to the stocks as they go up and up. So the Achilles heel of market cap investing is during the boom times and the bubbles. Because when things go totally nutty to the upside, and we've seen this in dozens of markets historically, you put most of your money in the things that have gone up the most at the exact worst time. So if you think about the late 90s, you put all your money in these tech stocks that had just gone up to crazy valuations. Japan in the 80s, put money in these Japanese companies, and Japan was twice as expensive as the U.S. is today. So theoretically, the U.S. could still double and not be the most expensive country ever in the sample. And Japan was the largest stock market in the world. So if you're a cap-based investor, you put most of your money in Japan at the time it was the most expensive, and then went nowhere for 30 years. Ditto for China and India in like 2007, on and on. And so the real key is like, everyone loves to throw around the term bubble. And to me, until you get above this sort of 40 CAPE ratio threshold, I don't think there's bubble territory. And US is the only country in the world that's at 40 today, right? So most of the world is totally reasonable, down around 20. Most of the countries are in the teens, and there's, I think, one country still below 10. But so there's a world of opportunity around what you can do. And even if you're a U.S. investor, say, look, this foreign's too scary, emerging's too scary, fine, do value, quality within the U.S. There's a Grand Canyon-wide spread between the cheap stocks in the U.S., the market cap weight, because it's dominated by these expensive companies, and high quality. We obviously like shareholder yield, which tends to skew a little small and mid cappy just because they've done so poorly relative. But we have a large cap shareholder yield fund too. But I'll give you a fun stat just because we started to talk about foreign and emerging a lot. I went on TV the other day around Halloween, and I said, I'm going to give you guys a spooky statistic. Now, no one's going to believe this, and so you guys can go test it afterwards. And we run a global deep value fund that buys the cheapest countries in the world.
Okay.
And so I said, everyone knows that foreign stocks have underperformed the U.S. forever, okay? And everyone knows they're having a pretty good year. That type of strategy is up 50% this year. And so it's now beating the S&P over the last 1, 3, and 5, right? So there's been a momentum shift. No one's talking about it yet. So the sentiment hasn't even moved off zero. I go talk to advisors all the time. And I say, hey, do you own foreign? Do you own emerging? And they kind of look at me as I'm stupid, like, what's wrong with you? And I joke with them. I say, for a long time, clients would review their year-end statement talking about the diversification problems. And they say, you idiot advisor, why do we own emerging markets? And I joke by the end of this year, they're going to sit down and they say, you idiot advisor, why do you own emerging markets? Why don't we own more? Because the average allocation for a U.S. investor in emerging markets is like 3%. And the market cap weight is 10 of just equities. So if you think, I like to smooth, so 60% U.S., 30 foreign, and 10 emerging. But almost nobody owns any foreign and emerging. So there's a lot of diversification opportunities. And if you look at even the global value, despite being up 50 this year, P/E ratio on that is low teens to 40 for the U.S. So it's a pretty opportune time. It reminds me not so different from when I was in Tahoe. People expect the S&P just to go up and beat everything forever. The decade after 2000, anything beat the S&P. Gold, bonds, stocks, values, small cap, on and on. It was the exact opposite of and that's kind of what happens in markets. You have this, very, very technical phrase, but the good times follow the bad and vice versa. It just you never know how long it's going to last is the challenge. And so this could be the start of a 10-year foreign stock outperformance.
Yeah.
We don't know, or we could just be back to the cues, ripping and roaring by year end. Who knows? I don't know.
Yeah. Yeah. Diversification. It's like one piece of that diversification puzzle you're always going to be mad at. You're going to be upset with, but that's when diversification's working, right? Diversification's working when there's a piece of that puzzle that you're upset you have 5% in, 10% in. But that's the role it
Best the
plays.
best the best descriptor there that I've heard is saying being diversified is always having to say you're sorry. But
Yeah.
that's a feature, not a bug, right? Is that
Yeah.
something is always stinking up. So we do a series with our investors. Everyone loves if you go on socials or TV, they love to brag about how smart they are, what's doing great. When you have 20 funds, something's always stand up. And so we do a series where we'll talk about our worst performing fund. And so we did one with a value and momentum strategy years ago. We did one with this global value strategy. And I think, sacrificing at the altar of the humility of market gods is that they can reward you as opposed to the opposite, beating your chest and hyping everyone. And so almost to the day, those two strategies have turned around. And we need to do one now for our managed futures fund because we have a traditional managed futures fund. And the managed futures category, I think, just went through either the worst or the second worst 12 months it's ever had back to the SocGen Trend Index inception, I don't 30 something years ago. So we need to write one there so we can craft a turnaround. But that's how it works.
Yeah.
Something that's the whole point of diversification. You want them to zig and zag.
We talked about cap weighted, the benefits, maybe some drawdowns about cap weighted indexes and investing in, Spider, VO, very popular, biggest ETFs out there for a reason. But diversification, you can diversify within other passively managed ETFs, like equal weighted strategy of the S&P 500. Do you think there should be a bigger focus on equal weighted strategies, especially if moving forward, maybe we have a slowdown or a pullback here in equity performance?
I give you a secret, and anyone listening can steal this. I'm going to get this secret magic trick on how to outperform the S&P 500 or any cap weighted sort of index by 20 basis points per year. Which, if you're BlackRock or someone, how much would you pay for that knowledge? A lot. And it's the simplest idea. You just take out the largest stock, and that's it. And you can go back 50 years. And our bud Rob Arnott over at Research Affiliates has done a lot of research here where he talks about the problem with cap weighted indices, and he'll look at indexes and broad markets. He'll look at sectors, industries, countries, and usually the top position underperforms that index by about 3 percentage points per year for a decade. And the reason being, it just gets big. I mean, the worst strategy on the planet you can come up with is investing in only the largest stock when it's the largest over time. That outperforms the S&P by a mile. And so one of the simplest things you can do is just break that link. And one way to do it is equal weight, just because it's simple, right? So you're still getting broad exposure. You can see the hat I'm wearing is USEW, which is the next fund we're launching in December, which is targeting the top 500 companies and breaking that market cap link. But there's lots of ways that I think you can weight the companies that I think are totally fine. So you could do it. We obviously like shareholder yield and value. You could do it fundamentally weighting, which is what Rob talks about. There's a lot of research out there. There's our buddies at Robeco, PIM, and others have published a book and some white papers. They call it conservative investing, but they take a strategy that's similar to shareholder yield and they let you download all the data online.
Yep.
The problem that people have and the struggle with this strategy, and this says so much about markets in general, is every once in a while, those big market cap companies go on an absolute heater. It's like you go to the roulette table in Tahoe and you watch this who's sitting there and they say, I've seen 8 reds in a row. I'm betting black, and then black goes 10 blacks in a row, right? Like, it's a near 50-50 bet,
Yeah.
but they know. They figured it out. And so it's the same thing with markets, right? If you look at a chart, and there's lots of ways to cut this up, and you say, look at the most concentrated positions. It could be the positions trading at 10 or 100 times revenue on and on. And over time, that tends to be a terrible way to invest relative to the S&P. But every once in a while, it'll go on this just absolute moonshot face ripper, and then it'll just go back down and underperform for a really long time. And so you get traditionally it's these boom times, right? The market cap races like the late 90s, and we mentioned a few others as well. So, these type of periods tend to be type of periods that set the stage for the next, outperformance. But if you look at the equal weight valuations, they're much better than something like the market cap index in the US.
Yeah, bark up this tree all the time about using rolling returns versus trailing returns. And this is a prime example. If you look at the cap weighted S&P versus equal weighted 1 3 years, it's like, why go equal weighted? But if you peel away those layers and you look at whether it's 3 year, 5 year, even 2 year rolling windows, there's a lot of times where equal weight outperforms, especially during periods of slowdown, during the times when you want diversification, need diversification, and it works. So if you think that maybe we're at a time where we're going to roll over, equal weight's a good way to still have exposure to the S&P 500.
Well said.
Let's talk about that. Here's run up Nvidia. Let's say you're concentrated on some of these big AI names. You're concerned. I want to lock in these gains. Want to lock them in. Take the gains off the profits off the table. What are some strategies that help prolong that paying Uncle Sam in case you know what you do sell? Now you got this hefty capital gains tax. Are there any ways to prolong that?
First of all, congratulations and God bless. It's been an amazing run if you've owned that or similar stocks. And historically, there's been sort of two choices. And the first is, you hear someone say, I can't sell it. Taxman's going to kill me, right? Like I don't want to give up all my gains. I know it's expensive, but I want to diversify, but I just can't. And you can substitute NVIDIA for any stock that's done really well. And you may feel like it's time to let go. And so a lot of people said, you know what, taxman is going to kill me. I'm going to hold it. I'm going to deal with it. And the second way is traditionally they just sell it. They say, okay, I'm going to sell some. I'm going to sell all. I'm going to pay the gains. It's too risky for me. I got all my net worth in this company or this exposure, and it keeps me up at night. And that's not the whole point. Like I want to move on and live the life. And so, there's a third option that we've started to roll out over the last year, which has actually been in the tax code longer than I've been alive, but it really met its perfect partner or spouse with the ETF structure, and particularly post 2019 when the ETF rule passed. And this is called the 351 exchange. Going back in history, 351, let's say, we wanted to start a new ski shop in Tahoe. It basically lets you, if you're contributing property to a new corporation, it's not a taxable event. And so, an ETF is a registered investment corporation, but with the RICs, the regulators in there said, we don't want people doing this for tax reasons alone, so you have to contribute a diversified portfolio. So let's say you have a dozen stocks or ETFs or something, and you got these huge gains, you're sitting on a 10 bagger, you got the Qs at a 20 bagger, and you say, I want to diversify into an ETF. So you can contribute these to the seed or the launch of an ETF. And so we can use the one we're doing next month, USEW, and you get the ETF back. And that's not a taxable event. Now, you're not washing the taxes, of course. Just to make it clear, if you submitted 12 stocks, then you would get back the ETF, and it would have 12 cost basis line items that match the original cost basis of what you contributed. But what it does allow you to do is to get into an ETF and diversify and rebalance in the future and be able to move away from that concentration you may have already had. 351s, there's probably been over 100 of these. Traditionally, they've been an asset manager that'll take like a mutual fund and convert to an ETF, like DFA did, I think, 100 billion of these, or a hedge fund. You haven't really seen anyone do this, what we call open enrollment, where you're opening it up to financial advisors anywhere, individuals, ETF Architect, who's our partners on this, if y'all know Wes Gray. Only one's been doing this open enrollment. So when we started doing this a year ago, we said we're going to lay out a buffet of 4 ideas, because I have my own Meb ideas of what I think people would want to diversify out of and into, but people have their own ideas and needs and wants and timing. And so the first fund we did a year ago was a US stock fund with a value tilt. Then we did a diversified, like allocation, endowment style strategy. Then we did a global stock strategy. And then next up is the US strategy. And then, so if you're interested, you guys got to email me this week because we're cutting it off at Thanksgiving as far as the submissions. But we'll do a couple more next year, so don't worry. We're not leaving you out in the lurch. But the two big requirements are the biggest position can't be above 25%. So let's say you got 10 million Tesla. Well, you can't just give me 10 million Tesla. You could give me 2.5 million Tesla and 7.5 million some other stocks or ETFs. And then second is the top five positions can't be above 50%. So the takeaway is you either need 12 stocks or, and this is a giant or, ETFs are pass through. So give me 100% SPY if you wanted, because it looks through to the underlying holdings. You could give me 2.5 million Tesla, 7.5 million SPY, and then you get the ETF back, and there's no lockup. Our next fund is only 25 basis points, 0.25%. So it's a pretty cool idea. And theoretically, and I love when I'm talking to any regulators or people in the media about this, this makes our financial markets much more robust, right? So people are still paying, so it's not a tax dodge. And they're diversifying out of theoretically concentrated risk exposed positions into more diversified. And so it theoretically recycles out of it. It theoretically has the potential to dampen the booms and the bubbles and recycle it into a more healthy type of market. I'm trying to get my academic buddies to write a paper on that because it's more than my chops. But anyway, it's a pretty cool idea that 99.9% of people have not heard of.
Yeah, I'm glad you brought that up. A lot of people don't know, but it's been in the tax code for, like you said, years and years. Why do you think people just don't know about it? Is it they haven't read that stack of tax code and they just don't know, or is it
Oh,
just
there's
a little
look,
too
taxes
complicated?
are most people kind of deal with taxes when the bill comes due, right? Your tax
Right.
planning is like December 30th and then again in April. But, there's a lot of ideas in the tax code. 1031s, most people understand 1031s, right? Real estate, you buy a hotel in Tahoe, you own it for 20 years, you sell it, and instead of paying the taxes, you roll it into a different property. That's how generational wealth has been built in real estate for forever. And the similarity with stocks, again, I think the perfect marriage didn't really happen until 2019
Okay.
for the ETF structure. And so, but why aren't more people doing this? Why isn't it more widespread? Why can't you go to Vanguard and BlackRock and do it? And the answer is because it's a lot of work, and it's a lot of herding cats. It's a lot of, financial markets. So much of it is about plumbing and infrastructure. And so a lot of the custodians, like, not sure how to deal with it. You can't do it in any of the wirehouses. So you go, if you're at UBS or Morgan or Merrill, I think one of them will be able to do it next year because they're
Okay.
getting a ton of pressure from their clients. Some of the custodians can't do it, like Fidelity. So on and on. It's something new. And if you know anything about money, money tends to be very happy, warm, and cozy where it is. But when you start introducing a lot of new procedures and ideas, the traditional incumbents, it can be a little slow at that. So I think 2026, you're going to see it's going to be the story of next year. We've been trying to educate people, but still zero private equity, CEOs, VCs. There's kind of four main use cases. The first one is the most obvious, which is concentrated stock.
Yeah.
The second one is direct indexing. So you're starting to big interest in long, short direct indexing. But a lot of people out there say, man, that's just too complicated. It's too expensive, on and on. So this is a good solution and off ramp for that. Third is a strategic rebalance. So, if you were 60-40 back in 2009, well, you're 90-10 now. And so that's offsides. And the last one, and so if you're an advisor listening to this is the biggie. If I was an advisor in a state, or I would say, oh man, I'm going to go talk to every public corporation in my town, and I'm going to say, let me give a presentation to your C-suite, to your investor
Mhm.
relations, because I'm sure you have 100, 1,000, 10,000 people who have concentrated stock, and they don't have a solution for it, and they would love to diversify. Ditto with PEs and VCs, on and on. So it's actually a huge biz dev opportunity. There's so many people out there that have this issue that don't have a solution for it.
Yeah. And I completely agree about the trends in 2026. I had Scott Smith on from Cerulli, and that he said that's one of the biggest trends they're seeing in Cerulli is, and your name came up, Meb, about the 351 exchange and how it's starting to build some traction. And he said it's a trend to watch moving forward.
Yeah,
That's
I
what
think I think 26, 25 has been the education, and
yeah.
if you Google it, you can go to Cambria Funds and other places. 351. We got a ton of materials on there, podcasts and webinars talking about it. And like anything, the process is getting cleaner and streamlined. And we'll have again, if you missed the one in December, we'll have another one in May and in November as an onboard. And then if you're an asset manager that wants to do a custom one, because some people say, "Love this idea, love you, but I don't want your crazy ideas. Can we work on a custom one? Reach out, and we're happy to have that conversation."
Yeah, fantastic. So you brought up how Cambria can help financial advisor, all the thousands of financial advisors that are watching this. They're like, okay, I'm jumping on board. How can Cambria, what's the next step that for a financial advisor to get this process
Yeah,
started?
we'll do a case study now on the next fund that we're launching in December, just to walk through. So let's say you're an advisor and you're a very just traditional advisor and you custody at Schwab. Schwab's like the easiest one. And you say, "Oh, perfect. I got this client, Joe Smith. He's got 10 million with his wife and it's 20 stocks. It's a bunch of Mag 7. He's super nervous about it and wants to diversify out." Say, "Okay, email us." And it's actually a pretty simple process. There's basically an Excel sheet you'll send over. We'll send it to you. You just got to fill it out and say, "Here's the positions. Here's the cost basis. Does it meet the diversification criteria?" And you'd be surprised, even when people know the rules, they'll submit, "We don't want your Dogecoin, no mutual funds, no hedge funds, no futures, no options, no shorts, nothing margin. Just think publicly traded stocks." And it has to broadly match the mandate of the fund. So you can only contribute US securities for this next one we're doing. The last one we did, you could do foreign, although no one has any foreign stock appreciation. And then theoretically, on the asset allocation one we did, and we'll do another one, you could contribute all sorts of things, right? Bonds, Bitcoin, REITs,
Okay.
commodity equities, on and on. So there's a bunch of different criteria, but let's just keep it simple with the US one. So say, okay, you're going to submit your 20 positions, send us the Excel sheet. We upload it in this software tool that we have, and we say, all right, it checks out. You got to notify the client, sign a form or two a couple days before the launch. We say, stop trading it. Thanksgiving, go enjoy your Thanksgiving. Send us a statement at the end of the month in December. The fund launches mid-December. 2 days before the security is transferred to U.S. Bank, and then after the fund launches, you got a ETF in your account now. It's like magic, and then there's technically no lockup. You could sell it the next day, but obviously you're paying taxes on whatever you contributed. So most people tend to hold. So if you look at our last three launches, they've actually all grown since. And then after that, it's like any other ETF. Anyone could go buy it after launch. And then depending on what's contributed, there tends to be a little bit of a transition period from that portfolio to kind of where we're going. These are actively managed strategies, but we say, we try to keep them very, very highly correlated to where we're going. So usually day one, kind of week one, month one, they're already 95% correlated to the final portfolio. But it gives people a lot of comfort traditionally if they're super highly concentrated to go from their position to all of a sudden having 100 or 500 positions, the next day.
And they get to prolong that tax bill. So
You get
everyone
to
enjoys.
defer it, and then you can do whatever you want, whether you donate it, you could sell it, you could manage each position granular, you can, do it till you die, whatever it may be. And then the nice thing about the ETFs is they can rebalance tax efficiently, et cetera.
Meb, fantastic. Awesome conversation. I knew when we lined this up, I was going to learn a lot. Did really fun talking about markets and stuff. Where can our audience get more information about Cambria Investment Management and your thought leadership?
The nice thing about having a name like Meb is there's not too many others out there. So I got a blog, Meb Faber. I got a podcast, Meb Faber Show. You can find me on the social fights with people like Twitter and LinkedIn. The day job is CambriaFunds.com. as well as CambriaInvestments.com. So we got all these white papers and books for free online that you can download and shoot me an email, and we'd be happy to mail you a hat.
Awesome. I cannot recommend your blog, the podcast. I watch it. I read a lot from your blog, trying to learn as much as I can, take it all in. Fantastic. Love
I
it.
got one more. I forgot. I forgot. The Idea Farm, which is our free research service. It's like it's supposed to be accompany your Sunday Barons. We send out once a week. It's free if you go to theideafarm.com, and it's like the top 2 or 3 reads each week, institutional, and top 2 or 3 podcasts and links. I don't write it anymore, and it's actually really, really, really good. So check it out. It's free to sign up.
Yeah, it's so much. I get it on LinkedIn. It's so much easier than me trying to Google and figure out. It's a lot easier. Fantastic
Yeah, and the
stuff.
best part is we just redid the website. So
Okay.
there's archives of the past 10 years of the best content that Goldman and Bridgewater and everyone has published. You can go read them, download them, sort them. They got summaries. It's a pretty cool resource.
Awesome. Awesome, Meb. I want to have you on. Let's talk next time. We'll talk more Tahoe. I love to have you on to talk about shareholder yield too. Fascinating
Yeah,
investment strategy. Really like it.
let's do it
So
again anytime. I'd love to.
awesome, Meb. Thank you. Thank you so much. And thank you everyone for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Please be sure to subscribe and like those channels and give us a follow on LinkedIn. Thank you and have a great rest of your week.